All right, I'm gonna add that to this list. So please stop taking tax advice from Facebook groups and your broke uncle and Joe Bob, as you said, Morgan. Like, please, please, please. Like, if you hear something on TikTok, that's great. Please run it by your tax accountant before you do something. You didn't start your practice to barely hang on. I'll guess you started it for freedom, impact, and profit. This is Therapy for Your Money. I'm your host, Julie Harris. I'm an accountant, author of Profit First for Therapists, and CEO of GreenOak Accounting. Over the years, my team and I have partnered with hundreds of private practice owners, whether they're just getting started, scaling into thriving groups, or even preparing to sell. We've seen it all, and we know exactly what makes a practice tick financially. On Therapy for Your Money, I'll help you build a business that truly works for you. You'll get quick, actionable tips and episodes so that you can grow a profitable practice, increase your financial confidence, and pay yourself unapologetically, because your work is way too important for you to burn out or go broke doing it. Love the podcast? Make sure to follow and give us a 5-star review. Here is Therapy for Your Money. Hello, everyone. Welcome to Therapy for Your Money. Today we have a special tax episode for you. And we have none other than two of our tax team members. We have Morgan Hess and Linda Roberts with us. Hello, hello. Good to see you.
Hello.
Hello.
So Morgan and Linda are on our tax team. So at GreenOak Accounting, we mostly do monthly accounting and CFO services, but we also do tax preparation for our monthly accounting clients. And so Linda is our tax senior. And Morgan, both of you have been on our tax team for like 3 or 4 years at this point, right?
I just had my 4th year anniversary.
Oh, happy anniversary, Linda. So you've been around the block, right? That's where I'm going is you've been around the block. You've worked with just filed hundreds of tax returns for private practice owners. And so what I wanted to chat about today is what are some of the things that you wish practice owners knew about taxes? Just because sometimes you will talk to them only at tax time, depending on the relationship that we have with that client. And by the time we get to tax filing, sometimes it's just too late for some things, right? And so we're talking today about what are the things that make you a little bit salty during tax season that you're like, oh man, I just wish that the practice owner knew this or had gotten ahead of this tax item, right? Something along those lines. So where should we start today?
I think the first is understanding how their business is taxed. So you have different business entity types. So you can have a partnership, an S corporation, or a sole proprietor, which is a Schedule C on your personal tax return. Those tend to bleed into a lot of our frustrations depending on what type you are. So with our S Corps, you are paid a W-2 wage. So you have withholding on your W-2. A lot of people don't understand that withholding on your W-2 does not cover your business income, your business profit. That withholding is only meant to cover your wage income. So that's something that we kind of deal with a lot is people not understanding why they have to pay estimated tax payments.
In addition to their taxes on the W-2.
Yes.
Yeah. Well, and if a business owner doesn't know what entity their business is, like what would you recommend?
Well, one thing we do at GreenOak is when we onboard a new client, we get a copy of their EIN letter. So we know what type of entity they are. We'll get a copy of their tax return. And based on that, we can determine what their entity is and how we need to file their tax return. And then, of course, if a client really doesn't know, we can point it out and educate them on how they file and how they're taxed, whether it's a separate business return, the S Corp partnership, which then flows to their personal return, or if it's actually on their personal return as a disregarded entity, Schedule C. And we can explain how it all comes together, but it all flows still to that personal level.
Yeah. And one thing, like, I know that sometimes we can look at the prior year tax return to see, what was filed, but even that can be misleading because I know we've encountered a number of times over the last couple of years where maybe an S Corp return was filed, and then years later we hear from the IRS who's saying, like, why are you filing this? We didn't even process it, right? Can you talk a little bit about that?
Exactly. We have had clients where that's happened, and then we want to request a copy of their S Corp election paperwork, whether or not it was actually filed. And we have found cases where it was either filed and just never processed, or it was never actually filed. And then, of course, we have to deal with the IRS to make sure that we get that election in, and then so the returns can be processed after that. Because the IRS, they'll just keep those returns sitting there, not processed. Yeah. So we've got to make sure we get all of those processed for them.
And like that's part of the frustrating piece for us, right? Like they have the return, they won't process it, and they won't say anything about it. They'll just kind of hang on to it.
Or in 5 years, then they'll send them a letter saying, this is the tax you owe because we converted your S Corp return to a C Corp because you don't have a proper S election. So sometimes we've seen that a couple of times, not as often.
How generous of the IRS.
Yes.
Yeah.
And it is many years later. That's the problem. It comes up, and it's from even before the time that they became a GreenOak client. But then, obviously we're going to help resolve that issue.
Yeah. And it's usually fixable, but it's a pain to fix. Like a pain for everyone, right? Not just like, oh, we don't want to do the work, but like it's going to take months to fix.
Correct. Because you're dealing with the IRS.
Yes. All right. What are some of the other items that you just wish practice owners knew about taxes?
Well, one thing, kind of add on to what Morgan was talking about on how they're taxed with their W-2. We also want them to be aware, we've got some clients where they're constantly changing their withholding on their W-2, thinking that, okay, well, everything has to go through my W-2. But then what happens is then they have to increase their wage because they need more take-home pay, and they're increasing their withholding. So we want to recommend just the W-2 covers your wages, and then we do the quarterly estimates for all of the business income.
What they don't realize, they're increasing their overall taxable income by increasing the wage to have the extra withholding. And then they also have their business income, which a lot of times they're increasing the withholding because their business income is up. So they just keep pushing their income up and up and up by trying to increase the withholding on their wage.
Yeah, and I'm going to sidebar here a little bit, but I am still to this day surprised at how many business owners double their income and then are just shocked that they owe more in tax. I don't know how they imagine the world works, but like if you're making more money, your tax bill is going to be higher. And really every year we get people who are shocked, even though we've talked about it, we've gotten ahead of it, but they're surprised. There's no magic wand that we have to make the tax go away.
Correct.
And that happens surprisingly often. Like if you make more money, you're going to pay more in tax. And that's a good problem to have. That's my perspective on it.
That's my philosophy. I always say, you're making the money. So I'd rather make the money and pay the tax than not make that extra money.
Yes. Because those are very different conversations.
Exactly.
Yeah.
Exactly.
Like, hey, you made no money. You owe no tax, but you also made $0 last year. That's not good. That's not good. Yeah.
No, you're right. And it's a good problem to have.
Yes. Yes.
The next thing I think I would like to mention is making sure business owners need to understand, like an S Corp owner needs to understand how your distributions relate to your basis and the potential possibility of having some distributions taxed. Your basis is your equity, your investment in the business. If you've got a certain amount of net income, but you keep pulling out more than the net income every year, your investment, your equity in that business is going to become negative, and you're going to get taxed on some of those distributions. It's basically tax on excess distributions above basis. So we really want to make sure people understand that concept.
And those are some big tax terms, but Linda, one of the ways that this happens often is if there's significant debt in the business, right? They're using credit cards to fund the business, or a line of credit, or some kind of debt to then pay themselves more than the equity they have in the business, right? So typically, almost always, there is debt involved when that's possible, right? Because the money has to come from somewhere.
Yes and no. There is times when it's debt, and there's other times when the net income is really good, but they're paying everything, all of their personal expenses, their kids' private school tuition, all of their personal expenses. They're kind of running through the business and using it almost like a piggy bank.
Okay.
And we can't have that because you're taking too much out of the business. The net income, no matter what the net income is, if you're taking out more than that net income, you're destroying or bringing your basis down to zero. And then you've got the potential where you're going to be taxed on those excess distributions.
Yeah. And little asterisk here is just because you run your personal expenses through the business does not make them deductible at all. Like that does not change the deductibility, right?
Yeah. And it is a lot of times debt, but it's personal debt. And what business owners aren't realizing is even though you are the owner of the S corporation, you still need to keep your personal and your business completely separate. There's no reason to be paying your car payment through your business or your kids' tuition through your business. All of that should come from your personal funds rather than business funds.
Yeah. Speaking of cars, I think that was on your list as well, right? Should we talk business vehicles versus personal vehicles?
We absolutely can. From GreenOak tax team's perspective, when you're looking to purchase a vehicle, if you want to purchase it under the business versus your personal name, if you want it to be a business vehicle, we recommend it needs to be used for business more than 80%. And that does not include commuting from your home to your office. You still need to keep track of all your miles, because if it's a business vehicle, the business owns it, and you're using it for personal purposes, you're taxed on that personal use on your W-2. So that is why most practices, we would recommend buying it personally, keeping track of your miles, using your accountable plan. The business can reimburse you for those business miles.
Yeah, a lot of times people just want to go purchase it because somebody told them like, oh, you need a deduction for your business. Go buy a car, get a deduction for the business. And that's not necessarily the case. Business owners don't realize how much work it is to actually have the documentation and the things to back it up, because there are things that they can be audited on that if they're not using it properly, especially if they're not taxing that personal piece. So don't just listen to Joe Bob off the street telling you to go purchase a vehicle to get a business deduction.
All right, I'm gonna add that to this list. So please stop taking tax advice from Facebook groups and your broke uncle and Joe Bob, as you said, Morgan. Like, please, please, please. Like, if you hear something on TikTok, that's great. Please run it by your tax accountant before you do something, because a lot of times, sometimes they're just straight up incorrect, right? Like they're just plainly illegal or incorrect, but they're not a licensed professional. So there's no recourse. And sometimes there's a lot of asterisks to those tax tips they're giving, and they may not actually apply. But this is a hill I will die on. A business owner should not go find deductions. I'm using air quotes. I know you can't see it if you're listening to the podcast, but finding deductions typically means you're buying things that you don't need to reduce your taxable income. And so that means you are spending $1 to save $0.25, right? And I'm generalizing because not everyone is going to be in a 25% tax bracket, but like you're spending $1 on something that you don't need to save a quarter. So in most cases, and this is where I get really heated, I would much rather see you pay that quarter in tax and have 75 cents left than buying things that you don't need. If you don't need a new car, please do not go buy a new car just so that you may or may not have a tax deduction. That is really silly. Keep the money and keep driving your older car because yeah, you're better off with the cash. And we're big fans of just using like reimbursing yourself for mileage, right? Instead of don't buy the car in the business. That almost never makes sense. We see a lot of new clients to us have that, but like that almost never is done properly. Use mileage. Just track your mileage, reimburse yourself for legitimate business mileage. Yeah, don't buy the car in the business. All right, what else?
The newest advice giver that we've seen actually is like ChatGPT or internet searches.
Yeah.
Just to not always say that it's incorrect, but they typically don't have the full story of your complex tax situation.
Yeah.
So it's fine to use those as research tools to ask about certain items, but as we've discussed in our team meetings, it needs to be taken with a grain of salt because a lot of times it doesn't actually apply to your situation.
Yeah. Yeah. To your point, like ChatGPT is a great research tool, but it does not have what we call in accounting, like facts and circumstances, right? And that, I'm using air quotes there again, like that's the accounting term, but we have like your prior year return. We know what your business entity is. Like we know your spouse's situation. Like we know all of those things and all of those come into play. Which ChatGPT does not have that and should not have that. And you probably should not upload your tax return to ChatGPT either, especially if you're using the free version. Like please don't do that. But yeah, those are really important things when it comes to tax. Like it's very precise.
Yeah. And it's just like your neighbor, your sister, your relative, they may say something about their situation. You can't compare. It's like comparing apples to oranges. Every situation is unique for every married couple or a single person. Everyone's got a unique situation and you can't generalize and you can't compare because they're never exactly the same.
Yeah. Just like you wouldn't get your therapy advice from ChatGPT, right? Like you would not treat yourself or, get medication based on what you read on ChatGPT. Like you might bring that to your doctor and you should bring that information to your tax accountant. You should not use it to like diagnose yourself and treat yourself. Yeah.
Agree.
All right. I think we have time maybe for one more thing.
One thing I'd like to mention is when we've seen some of our business owners pay business estimates, they're not paying it under the business EIN. And they're paying it under their personal social security number. So people need to be really careful whether it's a business estimate or a personal estimate or a business payment or a personal payment. Make sure that you're paying it under the correct ID number, because we have had some issues with that in the past where they were paying a business estimate and it was under the personal social security number and they don't transfer.
Yeah. And Linda, so you're saying the EIN versus social security number, does the bank account where the payment originates matter?
Well, for a business payment, we want that out of that business bank account. We will see personal estimates come out of the business bank account, and that's okay. This way we have a record of them in QuickBooks. It'll just go to the equity section, as a personal distribution. So that's okay. But any business payments need to be out of that business account.
Yeah. Yeah. And EIN versus social security makes a really big difference.
Yes, because we have had issues. Then the IRS or the state will, they may send a letter because we've missed a payment, or they say you missed a payment, but it was applied. They paid it under the wrong ID.
Yeah. And is that fixable, or is that sometimes not fixable in the current year?
It can be. We've had to call and we've been able to get some payments moved, but other times they will not move a payment.
Yeah. And so that could that mean like you have to make an additional payment from the business and then your money is just locked up until you file your return next year, right?
Exactly.
Yeah. Or like you may get a refund, but it's going to take a while.
You're gonna wait a while. Exactly.
Yeah. That's unfortunate. Okay. We have time for one more. Last one.
I would say probably the getting into different states.
Okay. Oh, yeah.
Having therapists in different states, patients in different states. It's just complex. And that's something that you need to consider and probably talk with your tax preparer before you entertain the idea. It may cause tax liability, maybe payroll tax liabilities, all sorts of different things to just be generally aware of. But it's not simple.
It's not. Yeah. And so, Morgan, how does this usually present? Like, what are the most common ways that this comes up?
For us, we ask in our tax questionnaire every year where you have employees and where you have patients. So that's the biggest way that we catch it. Mm-hmm. Occasionally, clients do bring it to their accounting team and we're able to get ahead of it instead of, dealing with the consequences afterwards. Mm-hmm. But we generally see it in our questionnaire each year.
Okay. Yeah. And the way I see it present on the accounting side is often there will be an existing clinician who will say, hey, I'm moving out of state and I would like to keep working with you telehealth. And often the practice owner will just say, okay. And that's kind of it, right? But just completely separate from licensing, right? Licensing of the business and like your credentialing, completely separate from that. There may be income tax repercussions when you have either hire out of state directly or have someone move out of state that's income generating for the practice. Like there often are repercussions there. And what are some of the consequences when you have an income generating person out of state?
Well, every state is different. So that's one of the complexities is every state has a different way
to fund
house. Yes. So it can either cause you to have another state filing in that state. And that's generally what we do see, depending on if it's patients in a new state or a worker in a new state. But we see you're upping your tax liability across the states. So more tax filings, additional returns, all of that stuff.
Yeah. And both on the business side and sometimes on the personal side as well, right? Like if the business is operating in multiple states, that could also create multiple state filings for the owner personally. Yeah.
Correct.
And for patients, like if you have one patient moving out of state and you happen to be licensed in that state, like that's less likely to create a huge issue. But like if you're opening a location across state lines, for sure that's going to complicate everything, right?
Correct.
Yeah. Okay, so opening a location in a new state, would you do it or would you not?
No.
I would not.
It also depends on the state. I guess I should add that.
Okay. That's true. The combination really matters. Linda, what about you? Would you yay or nay it opening?
Again, it depends on the state. If you're thinking of opening something in a new state, or again, you have an employee moving, definitely consult your tax provider first, because depending on the state, we may say, oh yeah, you're fine. Or we may say, do not do that.
Yeah.
Stay away.
I don't know if we want to get specific, but for my, oh yeah, it's probably going to be fine. The first one that comes to mind for me is Florida. Oh yeah, it's probably going to be fine.
Yes.
Not super expensive to register. No state tax there. It's probably going to be fine, right? I'm not going to say always, but probably. And then the one state that comes to mind, you should not do that, is California. What are yours?
I agree. California, because even if it's if it's just an administrative employee and not an employee that has revenue generated, we have seen filing requirements. We've seen letters from California based upon just having an administrative employee in the state.
Yeah. Yeah. And kind of separate from tax, like having an employee in that state now subjects you to all of the employment law regulations of that state. And so if you're adding someone, even if they're administrative in a more highly regulated state, then you're likely going to have to adjust to that across the board. And that could be, paid time off or sick time or all those other kinds of restrictions. And so you may be inadvertently setting yourself up to have to add a lot of things that you were not expecting. Yeah. All right. Morgan, do you have a yes and no state? Like, oh, it's probably fine versus.
I would say I can think of Virginia as a clinician-based state. So they tax if you have a clinician working in the state. And then California, again, is a patient-based state. So, you're then getting taxed. You can end up double taxed on a lot of income whenever you get into situations like that. So
with a clinician in Virginia seeing clients in California, they're both taxing you.
Correct.
Yeah. Okay. Good to know. So whatever the combination is, this is going to be my takeaway. Whatever the combination of states is, you want to check that specific combination before you say yes to letting someone move out of state.
Yes, absolutely. Because again, it depends on the states and where the employee is and where the clients or patients are.
Yeah. The three things that could potentially create income tax nexus is employees, definitely, clients, and then location, right? So business, location, business assets. So those, if you have any combination of those three things or any one of those things, that could create income tax nexus in a new state. So proceed with caution. All right, ladies, thank you so much for your time today. This was this is always a fun topic. I enjoy talking about tax, but I hope that our listeners took a little something away of oh yeah, I did not know about this. And that I hope that it created some questions for them that they're going to now take to their own tax preparers and just be kind of better informed so that they can make better decisions in their business. All right, that is all for today. I hope you enjoyed this episode and learning a little bit more about tax and how it works in your practice, because I know it's not a part of business that you might be excited about. You're probably not super excited about taxes, but they are a reality of small business, and understanding how all the pieces of your business work really do help make you a better business owner over time, right? This is part of your reality, and understanding what needs to happen and how to get ahead of things can really benefit you long term. We really do have an incredible tax team at GreenOak Accounting. They are truly a special kind of detail-oriented and patient and kind folks over there. And so we only offer tax preparation services for monthly ongoing clients. But that is one of the great benefits of working with us ongoing, is to have access to this amazing, very, very knowledgeable tax team. So I hope you have a wonderful rest of your day, and I'll see you next time. Take care. That's it for today's episode of Therapy for Your Money. Catch us on Instagram and Facebook at Therapy for Your Money Podcast, and don't forget to subscribe to GreenOak Accounting on YouTube. Until next time.
The information contained in this podcast represents the host and guest's general opinions and should not be construed as personalized accounting and tax advice. Listeners should consider all facts and circumstances before applying this information and seek appropriate advice from an accountant, financial planner, lawyer, or other professional. Any info provided does not constitute accounting, tax, or legal advice.